Welcome back to Market Insights, where we dive deep into the stories shaping our financial world. I'm your host, and today we have a fascinating discussion lined up about the current state of the global markets. We'll be tackling three critical issues: the growing fears surrounding an AI bubble, recent scandals involving central banks, and the ongoing global trade tensions. Joining us today is our esteemed guest, a market analyst with extensive expertise in global economics. Thank you for being here.
Thank you for having me. It's a pleasure to be on the show and discuss these pressing topics.
Let's jump right in. The buzz around artificial intelligence is palpable, but some analysts are starting to voice concerns about a potential AI bubble. What's your take on this fear?
Absolutely, the concerns are valid. Many investors are pouring huge amounts of capital into AI-related companies, with the global AI market projected to around $1.5 trillion by 2030. However, there's a fear that this rapid growth may not be sustainable. We've seen similar patterns before in tech. Think of the dot-com bubble in the late 90s.
Right, and it's interesting to note how a few companies, particularly in the tech sector, have seen their valuations skyrocket almost overnight. Do you think these valuations are justified based on current revenue streams?
That's the crux of the issue. Many of these companies are valued based on potential rather than actual profits. For instance, while companies like OpenAI and others are making significant strides, the path to profitability isn't as clear-cut. Investors need to be cautious. A correction could be on the horizon if the market realizes these valuations are speculative.
So, you're suggesting that we need to temper our enthusiasm and take a more cautious approach to investing in AI.
Exactly. It's crucial for investors to conduct thorough due diligence. While AI has transformative potential, the fear of a bubble could lead to significant repercussions for those who invest without a solid understanding of the market dynamics.
Speaking of repercussions, let's pivot to the recent scandals that have rocked many central banks worldwide. What's going on there, and how is this affecting global markets?
We've seen several high-profile scandals recently, including issues of mismanagement and lack of transparency. For instance, the Bank of Japan has faced scrutiny over its aggressive monetary policy and the implications of potential inflation. Scandals like these undermine trust in central banks, which can lead to volatility in financial markets.
Trust is key, isn't it? When central banks are perceived as unstable, how do you think this affects investor confidence?
It creates a ripple effect. Investors may pull back from markets, leading to decreased liquidity. We've also noticed fluctuations in currencies, particularly in emerging markets, as they react to central bank policies. For example, the Turkish lira has seen significant depreciation, largely driven by concerns over central bank independence.
It's a complicated web, isn't it? And with central banks trying to navigate inflationary pressures while maintaining growth, it seems like a tightrope walk. How do you think they can regain credibility?
They need to prioritize transparency and communication. Central banks must articulate their policy decisions clearly and provide a roadmap for future actions to help instill confidence among investors. Consistency in policy can also reassure markets and mitigate fears of abrupt changes.
Now, shifting gears to the global stage, trade tensions continue to disrupt international exchanges. Can you unpack how these tensions are manifesting today?
Certainly. Trade tensions, particularly between the U.S. and China, have been escalating again. Recently, the Biden administration introduced new tariffs on certain imports, which has sparked retaliatory measures from China. This back and forth can lead to higher prices for consumers and slower economic growth.
It's a domino effect for sure. With supply chains already strained from the pandemic, how do you see businesses coping with this added pressure?
Many businesses are beginning to diversify their supply chains to mitigate risks. We're seeing a trend toward reshoring, bringing operations closer to home as companies look to avoid dependence on any single country. However, this transition takes time and requires significant investment.
What about the impact on consumers? How are these trade tensions affecting everyday individuals?
Consumers are likely to feel the pinch in their wallets. Higher tariffs can translate to increased prices for goods, from electronics to groceries. Additionally, if businesses reduce their operations or lay off workers due to increased costs, we could see a rise in unemployment, which would further affect consumer spending.
Ray, it's a challenging time for everyone. As we navigate these uncertainties, from AI bubbles to central bank scandals and trade tensions, what advice would you offer to investors?
Stay informed and adaptable. Investors should diversify their portfolios to manage risk better and consider sectors that are less impacted by these global tensions. Additionally, keeping an eye on macroeconomic indicators can provide insight into market direction.
Great advice. It's all about being proactive rather than reactive. Before we wrap up, is there anything else you'd like to add regarding the current financial landscape?
Just to emphasize the importance of staying informed. The landscape is constantly evolving, and those who keep up with trends and data will be in a better position to navigate whatever comes next.
Absolutely. Thank you for sharing your insights today. It's been enlightening to discuss these critical issues affecting global markets.
Thank you for having me. It's been a pleasure.
And for our listeners, if you found today's episode valuable, be sure to subscribe to Market Insights for more discussions on the financial topics that matter. Stay tuned, stay informed, and remember to invest wisely. Until next time.